Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is September 20th edition of Market Outlook. Don't forget to go to our website, sign up, and you'll get this free every week by going to www.marketgauge.com. All right, interesting week. Fed decision, uh, very much awaited. Lots of crosstalk about what they were going to do. They decided to stay pat. Markets did not like that, which is interesting because considering keeping low rates generally has been a big push to the markets. With this type of reaction, it begs the question, is the Fed stuck? Anyway, let's go to the charts. The text sort of covered what our viewpoint is. Let's see what the charts are telling us. We're going to look at some of the key markets, spiders, gold, bonds, and stick to that this week. All right. First of all, the S&P 500 built this sort of wedge pattern. What's interesting is intraday, as you can see right here, on Friday, you had a really sharp move up that it gave all of it back, retraced, and then sort of breaking the top of the wedge could have been perceived as clearing all of this compression zone, but we couldn't hold it. Very, very negative message. The market responded again on Friday. Now, granted, it had options expiration, which generally with that witching can be a negative day. So that added some downward pressure. And also S&P went ex-dividend, but on Friday. But nonetheless, this was a 3.5% type of sell-off in just a couple of hours, really about an hour and a half of actual trading time. And we ended up closing the week down after the Fed announcement and under this trend line here, which is sort of that wedge pattern that it broke out on the upside, failed, and now broke out to the downside. So we would have to say, obviously, this price action is negative. Taking a look at volume, we had one distribution day in the last week. We have had no really strong accumulation. Well, you had one, what I would call strong accumulation day about a week and a half or so ago. But overall, the evidence, and then you can see most of the action has been to the downside, right? The really big volume spikes above this yellow line here, which is the 50-day moving average of volume, is what I call a real accumulation or distribution day when you get above that and exceed the prior day's volume as well. And as you can see, Thursday, right, as we closed down, we had some excessive volume. That is very telling. We're neither overbought nor oversold. So you can look at this and say, with this breakdown, another potential test of the lows is sort of in order. Let's take a look at the calendar range, which I mentioned in the text version. And over here, the upper red line is the September calendar range high. And as you can see, there were a couple days here about a week or so ago where about 194.50 was a key level, right? Let's get that a little bit more exact, right? So you can see this red line. We sort of tested it a little bit intraday, but ended up closing well above it in both cases. And that allowed us to mount a rally from 194.50 almost all the way up to 203. That's a pretty nice size rally. Nonetheless, what is critical here is as we've now broken down under the wedge, this area is critical support. If we break down beneath that 194.50 level, looks like we'll certainly get a test to the calendar range lows, which is 190, and then ultimately potentially another test of that 182 level or so, which was the spike low on the 1,000-point down day. Now, conversely, Another critical point is the 6-month calendar range low, which is this thick red line. That also coincides with basically being unchanged on the year. So that calendar range low of about 205, the 6-month calendar range low that was set in mid-July is another key component. And you can see once we closed under that 6-month calendar range low, massive sell-off. So you got your key points here. If you can get and close above that calendar range low, which is basically unchanged on year-to-date performance for the S&P, they coincide. Coincidentally, that's very, very important. So those are your levels. Now let's go to the market internals. Volatility ratio. We were talking about that last week, how it looked like we were starting to recover. This is a bit more favorable. You can see we got oversold, started moving back above it as we recovered, and are still holding the lower point, which is about 1-to-1 between short and long-term volatility. So if we can get above the 1.05 level, that would be pretty good, and this moving average. On the other hand, another spike down, or starting to spike down below this the blue line, which is just above 1-to-1. If it starts going a little bit negative from there, I could see on the sell-off that this continue to drop down to extremely oversold. So it's always possible, especially if you're a momentum player and believe in that, which we do, that if you can break down beneath that blue line, that would mean not that we're already oversold, but that the rally that has taken place from the oversold level is now failing, and you're potentially setting up for at least another test of the lows. Let's take a look at some of the other indicators as well. The McClellan oscillator, which is looking at going back as far as 39 days. As you can see, we hit the upper band and came off and generated a sell signal, as well as the advanced decline. So as you can see here, advanced declines got up to an overbought level, could barely get above its last overbought readings, turned down, and has generated a signal. So that is a shorter term signal based on the 10-day advanced decline ratio. Volume is the weak sister. Couldn't get really any strength whatsoever. So I would look at this and the market internals looking at advanced decline levels and up-down volume, 2/3 on a sell signal. So net, I look at sentiment and market internals as a net negative overall. Okay, so that covers the key S&P 500 index, which is most likely the best one to look at right now with this clear technical pattern, the breakout, inability to hold it on a closing basis, and then a breakdown of the wedge and the ability to close under the wedge on Friday. So we are certainly at least setting up a potential test of the lows here, with the exception if the plunge protection team, and for whatever reason the markets rally, we know we're going to have to clear this key resistance level around 205, which coincides with unchanged for the year in terms of year-to-date performance for the S&P. Now, let's take a look at GLD. Okay, so with the gold market, we've got a scenario where we had some really interesting volume on Thursday at or around the Fed announcement. Friday, we continued to follow through. Obviously, most sensitive to interest rates is gold. It actually now is entered a recovery phase. For those following Elliott wave, you can say that this looks like a potential A way up from these lows here, but we are moving into a recovery phase. We had decent volume on Thursday, a clear accumulation day. We're not quite completely overbought yet. Obviously, we're going to have to get above the 200-day moving average. If we can get above the 200-day moving average in gold, we've got a completely different scenario, a washout, and then a pretty strong recovery. And seasonally, we are going into one of the best periods for gold and when it is prone to rallies. All right, let's take a look at TLTs. Interest rates themselves, you can see that interest rates here had some huge volume, not surprising since the Fed decision directly impacts TLTs. It is the instrument that is most sensitive to the Fed announcement. And obviously, huge spike on Thursday, follow through again on Friday, lesser volume, but still huge volume as people are adjusting to their positions. So we have right now what we call a recovery phase intact. We're trading above the 50-day moving average. It is flattening out, which is a little bit better than the gold, which has a declining 50-day. So if we can get a confirmation above there, we could see potential additional strength as the Fed sits pat, and that should be good for bonds. On the other hand, a failure here beneath the recent lows, probably all of this buying now would be trapped, and we would get a test of the lows. And from there, we would have to take a look-see and why interest rates would be moving higher along with that Fed announcement. So again, things are certainly unclear on the global macro level. Lots of disparity between some of the big players thinking that we should get the raise, others not. Obviously, the Fed thinking otherwise. And here we are sitting in this recovery phase, and some good volume came in at these levels. All right, so overall, as you can see, stock market under pressure, gold responding favorably to the lower or the steady rates at effectively zero, and bonds recovering and moving to a stronger position overall. That's it for now. Hope this helps, and see you next week.